Welcome to this explainer. Look, if you're feeling nervous about starting to invest right now, I just want you to take a deep breath. You are in the exact right place. Today, I'm literally going to be your mentor, walking you through the exact step-by-step roadmap to start investing in 2026 without making those classic beginner mistakes. Think of me as your personal financial coach. We're going to build a plan for your money that is practically bulletproof, step by step, and I'll explain exactly why we're doing it. Okay, so let's dive into this with a core truth that you really need to internalize before we touch a single dollar of your money. Building wealth, it actually isn't about perfectly timing the market. Not at all. It's about surviving your own human instincts. You see, the market has spent a century transferring money from people who get impatient right over to people who simply outsit everyone else. I really want to emphasize this. Doing nothing is actually your greatest superpower, and we're going to build a whole system around that one truth. So here's our roadmap for today. 1. The 2026 reality check. 2. Building your financial armor. 3. Picking your investment buckets. 4. The haystack strategy. 5. Putting it all on autopilot. And finally, number 6. Surviving the inevitable crash. Let's get right into step 1, the 2026 reality check. I know you're probably pretty nervous about starting to invest this year, and honestly, let's validate those fears, because smart people are sweating right now for a very mathematical reason. 40.7. That is where the Schiller CAPE ratio currently sits. Now that ratio basically measures stock prices against the actual profits those companies earn. To put that 40.7 into perspective, the historical average is only around 17. The only time it has ever been higher than it is today was way back in December of 1999. So yeah, we are currently looking at the second most expensive market valuation in 140 years of recorded history. And because the market is so incredibly top-heavy, literally just 7 major tech companies make up 35% of the entire S&P 500 right now. Big institutions like Vanguard are projecting much lower future returns. They're looking at somewhere around a modest 3.5 to 5.5% per year over the next decade. So you might be thinking, okay, well, great, I'll just hold my cash in the bank and wait for a crash. But here's the catch. With inflation sitting around 3.8%, holding cash means your money is just slowly dying. Waiting on the sidelines is statistically the absolute most expensive mistake you can make. Standing still is a guaranteed loss. Which brings us to step 2. Build your financial armor. Defense first. Look, before we can play offense in this weird market, we have to play defense. We are going to build you some financial armor so that you never, ever have to sell your investments in a panic when life inevitably throws you a curveball. So here is your strict, absolutely non-negotiable order of operations before you even think about picking stocks. First, get your employer's 401k match because that is literal free money. Second, kill any debt with an interest rate over 7%. Third, build an emergency fund of 3 to 6 months of expenses in a high-yield savings account. Then, and only then, max out your HSA and your Roth IRA. This right here, this is your foundation. And I want to pause on the debt thing, because destroying toxic, high-interest debt isn't just some boring chore. It is an incredible investment. If you have a credit card charging you 24% interest, paying that off reliably beats the returns of Warren Buffett, Bitcoin, or any genius stock you could ever pick. Think about it. There is literally no investment on planet Earth that guarantees you a risk-free 24% return. You gotta kill the debt first. Okay, step 3. Pick your investment buckets. Now, as a beginner, let's clear up a major point of confusion. Accounts like a 401k, an HSA, or a Roth IRA, they aren't actually investments themselves. They're just the tax-advantaged buckets that you put your investments inside. The bucket just decides how much the government gets to take from you. By taking advantage of your employer's 401k match, boom, instant guaranteed return. The HSA is absolutely incredible because it's triple tax advantaged. The money goes in tax-free, it grows tax-free, and it comes out completely tax-free for medical expenses. It's basically a stealth retirement account. And the Roth IRA? You pay taxes on that money today, so you pay absolutely zero taxes on the decades of compounding growth ahead. These buckets just make sure the government takes the absolute minimum from your future wealth. Alright, step 4, the haystack strategy. So with our buckets chosen, it's time to talk about what we actually put inside them. And this is where, as your mentor, I need you to completely unlearn what Wall Street has spent a century selling us. You're probably wondering, right? If the market is so expensive, shouldn't I just do some research, watch some videos, and pick the few genius stocks that are actually going to win? It feels like the smart thing to do. Hunt for the next Apple or the next Nvidia. Well, prepare to have your mind blown. A massive historical study looked at every single U.S. stock since 1926, and it proved that only 4% of all stocks ever created have produced all of the market's legendary wealth. Just 4%. The majority of stocks, literally 4 out of every 7 ever created, actually perform worse than a boring risk-free savings bond over their lifetime. Think of it exactly like this. Picking individual stocks is like trying to find a tiny needle in a massive haystack, where most of the hay is actively losing you money. If you try to handpick 10 stocks to find that needle, you will statistically fail. It's just math. So instead of stressing out trying to find the needle, we simply buy the entire haystack. By buying a total market index fund, we guarantee that we own those hidden 4% winners. We just embrace the fact that doing nothing and just owning everything is a literal superpower that consistently beats 90% of highly paid Wall Street professionals. And because the US market is so incredibly tech-heavy right now, a perfect globally diversified starter portfolio for 2026 looks something like this. 60% US total market, 30% international total market, and 10% bonds to kind of act as your stabilizer. Honestly though, if you want to make this totally effortless, you can just buy a single target date index fund that automatically manages this entire pie chart for you based on the year you plan to retire. The whole shebang. Done. Oh, and whatever you do, please avoid the 1% financial advisor trap. Paying an advisor a tiny, seemingly innocent 1% fee annually, it quietly vaporizes nearly a quarter of your total wealth over 30 years. Look at this. It drops a $761,000 portfolio down to $574,000. Fees are the only thing in investing that compound against you with absolute certainty. Just stick to those low-cost index funds we just talked about. Moving on to step 5. Put it on autopilot. Here's the secret. Success in investing isn't about being some genius who perfectly times the market. It's just about setting up a robotic, automated system that protects your brilliant plan from your own worst enemy. And yes, your worst enemy is your own emotions. Let's look at a super realistic journey. We'll call her Sarah. By systematically shifting her $450 a month from killing her toxic debt over to building her emergency fund and then finally into an automated Roth IRA, she completely transforms her financial life. She sets it up so the money is invested the literal day after she gets paid. By doing this, she is mathematically on track to clear $1 million with just 20 minutes of maintenance a year. It's not about big dramatic moves, guys. It's about automated consistency. And finally, step 6, surviving the inevitable crash. Look, as your mentor, we really have to address the elephant in the room here. At some point, maybe next year, maybe in 5 years, you are going to open your app and see your portfolio down 30%. It's going to happen. But the market collects its absolute biggest tolls from people fleeing the building. If you panic and sell during a crash, you turn a temporary paper loss into a permanent, very real loss. And worse, 7 of the 10 best market days historically happen within 15 days of the worst market days. If you panic sell, you will inevitably miss the explosive rebound days that your entire 20-year return literally depends on. Missing just the 10 best days in a 2-decade span will cut your entire return in half. So I need you to mentally write down this exact sentence to your future panicked 2 a.m. self. When it crashes, I do nothing on purpose. Treating the next crash as a scheduled entry fee rather than a crisis is the ultimate secret to outsitting everyone else and securing your wealth. You don't have to outsmart the market. You just have to outsit the people who try. So looking at your own financial future in 2026, are you going to keep gambling trying to find the needle? Or are you finally ready to own the hay?